the housing crisis wasn't quite as straightforward as you probably thought. It is true that millennials are buying homes at significantly lower rates than previous generations, with only 43% owning property by age 35 compared to 51% of baby boomers at the same age. But the reasons behind this shift and what happens next is explained by the full complexity of modern housing economics, demographic shifts, and financial market evolution. The United States is undoubtedly experiencing one of its most severe housing affordability crises in modern history. It has both the highest home price to income ratios in decades and the most constrained supply, making it no surprise that it quickly developed into one of the defining economic challenges of an entire generation. The smallest metro area experiencing crisis conditions, Boise, Idaho, no larger in population than some individual neighborhoods in major cities, still saw home prices increase 75% between 2019 and 2022, even though its economy is fairly well diversified away from traditional tech industry drivers. It focuses a good bit on remote workers from California, as well as manufacturing, agriculture, and other sectors. Neighboring Salt Lake City is similar. It's the next largest Western metro experiencing extreme price growth at 65% over the same period, though it too has diversified its economy by specializing in outdoor recreation and finance. Its downtown development is single-handedly responsible for transforming what was once considered a secondary market into a primary destination for young professionals. Then there's Austin, one of the top 10 fastest-growing cities at 48% price increases. Though in this case, there's little diversification. Technology companies completely dominate the city's recent growth story. These three cities, Boise, Salt Lake, and Austin, were put in a tricky, almost existential situation by the pandemic-era housing boom, as they're each heavily reliant on attracting young workers to fuel their economies. It was absolutely devastating to their affordability, but less so to the national housing market as they collectively represent just 4% of U.S. housing stock. Their influence on national prices is rather minimal. The rest of the major metros, though, are in a very different, more complex situation. The next largest market, Phoenix, saw prices increase about 52% over the same period, more than many smaller markets. But crucially, it has substantial land available for development on the urban periphery. Most Phoenix construction is in or near existing suburbs, as that's where the infrastructure physically is. But in 2015, the city started relaxing zoning regulations. While official government statements tended to focus on the economic benefits and job creation of increased development, the true purpose was hardly a secret. Housing advocates had long warned about affordability challenges, and Phoenix officials knew they could actually address it. The metro area has abundant land. The development costs are relatively low, and all they'd have to do is streamline permitting and allow higher density construction to increase supply. While before the pandemic, a substantial portion of Phoenix's housing was single-family detached homes on large lots, a slim majority of new construction has shifted toward townhomes and smaller lot sizes, meaning the market was already adapting when this affordability crisis accelerated. Los Angeles itself, the nation's second largest metro, has actually perhaps counterintuitively developed a very similar strategy. Prior to recent reforms, its primary development pattern was low-density sprawl. Like with Phoenix and most of its neighboring California cities, the LA metro area has fairly restrictive zoning, so state-level legislation overriding local control allows higher density near transit to proceed despite neighborhood opposition. Despite LA's 10 million person population, 75% of residential land was zoned exclusively for single-family homes. An incredible concentration, but just as other metros were worried about losing young residents to affordability issues, so too was California for its future. So, it passed statewide zoning reform to allow higher density development. Senate Bills 9 and 10 were rarely invoked in practice prior to full implementation, but it's believed they could facilitate about 700,000 additional housing units with existing infrastructure and more with some upgrades. Seattle, however, is in a slightly different situation. Its geographic constraints are significant. It uses a narrow corridor between Puget Sound and Lake Washington that limits the vast majority of its expansion options. But unlike Phoenix and LA, it has no sprawling periphery for unlimited growth. Instead, it has upzoning in existing neighborhoods. And on paper, this is hugely strategically significant, perhaps even more so than Phoenix and LA's approaches. Not only does this bypass political opposition to sprawl, but also reduces infrastructure costs, which themselves have been a major impediment in recent years due to rising construction material prices. In practice, though, Seattle's upzoning is itself complicated thanks to the city's contentious politics. It's rooted through neighborhood councils, which, while part of city government, have their own advisory roles and in many ways act as separate power centers. These councils constantly quarrel with City Hall over whether developers have the right to build higher density and use environmental review as leverage, meaning the political winds of the moment dictate whether upzoning actually works in practice. Over recent years, it's predominantly been in a slow approval state, but this shifted in response to the affordability crisis, with new legislation passed between the City Council, Mayor, and state government in late 2023. It's believed that in time, this approach could facilitate 50,000 new units over 5 years, representing close to 15% of projected household formation. Lastly, there's New York, the nation's definitive housing market giant. It is the only major East Coast city with both extreme demand and extremely constrained supply, and it's taken advantage of this to maintain astronomical prices. Its 8.3 million person population spread across just 300 square miles was built in response to early 20th century immigration waves. And while demand never truly collapsed during this period, both economic forces and exclusionary zoning prevented significant new construction. It's not entirely clear exactly how much capacity the city could add via current proposals. While Mayor Adams himself has called for as many as 500,000 new units, and could potentially achieve this by converting commercial buildings and rezoning low-density areas, analysts believe the bigger constraint is political opposition from existing homeowners, citing perhaps just 200,000 units of realistic capacity over a decade. Regardless, that's a tremendous amount of housing. So much so that it would still maintain New York's spot as having the nation's third highest rent burden despite any new construction. Collectively, these 5 metros provide considerable insight into the crisis, demonstrating the complexity of the housing shortage. And that's added to the fact that even as cities struggle with affordability, a steady stream of new housing is getting built. So far, these have predominantly been luxury apartments or linked to investor buyers. But regardless, considering housing is a market with local variations, the supply these provide offers some downward pressure on rents in specific submarkets. While the affordability crisis certainly has been severe, when you add these all together, it's potentially more nuanced than what the headlines might imply. So why does limited new construction lead to such dramatic price increases? Well, there's a concept in economics called elasticity of supply. Effectively, it's the relationship between price and quantity supplied. For example, consumer electronics are typically fairly elastic products. Considering manufacturing can ramp up relatively quickly, it's just a matter of production capacity. The price offered influences manufacturers' decision-making a good bit, at least on average. Academic research has shown electronics have high supply elasticity, meaning a 10% increase in prices will lead to significant increases in production. Manufacturers will just build more factories or increase shifts. There are plenty of ways to expand. This also works in the inverse. If there's too little demand for a particular product, more than can be sold, then manufacturers know that they can reduce prices to clear inventory, thereby allowing them to optimize revenue. This concept also applies to the housing market. In recent years, there has been about a 3.8 million unit shortage according to Freddie Mac estimates. So, prices rose to match available supply with demand. The problem, though, is that housing is an incredibly inelastic product in the short term. Unlike consumer electronics, there's really no immediate way to substantially increase supply. Construction projects take years to complete. And the way housing is regulated makes rapid changes difficult. Among residential zoning, for example, 3/4 of land in most U.S. cities is restricted to single-family homes only, preventing higher density construction. And even when zoning allows it, heading through permitting, securing financing, and completing construction means people mostly can't quickly respond to price signals by building more housing. Even if developers learn to streamline processes or switch to modular construction, new housing only accounts for about 1% of total stock annually. The rest is existing homes, and a homeowner certainly isn't going to build another house in their backyard because prices are up, at least not without zoning changes. They'll just enjoy the appreciation, which might encourage selling eventually, but not in the short term. Long-term elasticity of supply is different. Cities will eventually reform zoning, streamline permitting, and make other choices that increase housing production. But in the short term, academic research looking at historical precedent suggests housing has a supply elasticity of around 0.6 in elastic markets and near zero in highly constrained ones like coastal California. The pandemic-era housing boom largely meshes with this. Its combination of low interest rates, demographic shifts, and remote work flexibility created unprecedented demand that supply simply couldn't match. And while that's consistent with theory, the magnitude surprised many. Anecdotally, experts have backed up this view. Even the CEO of Zillow has effectively said he thinks the shortage is worse than official estimates suggest. But how can a market underestimate its own shortage? Well, this market is not perfect. It has subjective, fallible actors of incredible influence, otherwise known as institutional investors. This sector makes its money by betting on what housing prices will do in the future, and through that are one of the largest artificial influences on how housing prices move today. Through a combination of physical property purchases and financial instruments like real estate investment trusts, they move the market ahead of the supply and demand-induced moves. For example, if they believe prices will imminently rise and therefore returns will be strong, they'll all rush to buy properties, hold them as rentals, contracting available supply and raising prices. So, of course, when done at scale, this becomes a self-fulfilling prophecy where what institutional investors are really betting on, at least in the short term, is what other institutional investors will do. The effect this has on the market is that the year-to-year movements follow a mix of narrative and reality. If a large consensus of investors believe housing prices will rise, then housing prices will generally rise. If they believe they'll fall, they'll fall. And this helps explain the pandemic boom. In the opening months of the crisis, the market's reaction to remote work possibilities and urban flight was rather muted. The initial lockdown started in mid-March 2020, meaning investors had weeks when typical spring buying season was disrupted to reflect on implications. And yet, following the first months of the pandemic, prices had only risen a fairly modest 2 to 3%. Summer's rise was more substantial at 8%. Then fall continued the trend, with double-digit annual increases becoming common. What was happening was that, as they always are, institutional investors' decisions were being influenced by narrative. Among them, there was a widespread belief in the opening months that effects would be temporary and urban-focused. After all, previous recessions had suppressed housing demand, which implies a typical downturn pattern. Despite the unique nature of this crisis, investors initially applied traditional frameworks, seemingly based on precedent. Whether it was the 2008 financial crisis, the dot-com recession, or earlier downturns, housing markets had generally softened during economic stress. After all, unemployment tends to reduce household formation, and conventional wisdom suggested people would delay major purchases. So, investors initially remained cautious. But then, reality happened. You see, as soon as major employers started announcing permanent remote work policies, all the major investment firms almost simultaneously published analyses suggesting suburban and Sun Belt markets would outperform. This represented a fundamental shift in how investors viewed housing geography. The implications were enormous. If workers no longer needed to live near expensive urban job centers, the entire spatial equilibrium of housing demand would shift. This means that investment strategies simply had to adapt. It's just too big of a change for firms to ignore independently. Investors hold properties for various reasons: cash flow from rent, appreciation potential, portfolio diversification, tax advantages. But the major firms operate with sophisticated models that essentially decide which markets offer the best risk-adjusted returns. In recent years, this has included places like Phoenix, Austin, Tampa, Nashville, and Boise. Within these markets, investors were effectively required to move quickly to capture opportunities before prices fully adjusted. But crucially, this rush of institutional capital had consequences beyond just those investors' returns. And this is exactly what happened during 2020 and 2021. This was one of the biggest factors that accelerated price appreciation beyond what demographics alone would suggest. Regardless of the fundamental demand from households, financial flows made it functionally certain that prices would rise substantially. As months turned into years, some investors started pulling back. But if anything, the damage was done as the costs of homeownership had gone up permanently for an entire generation, often requiring 30 to 40% of gross income for mortgage payments rather than the traditional 28% threshold. This makes for a massive additional burden that is unlikely to subside soon, since temporary disruptions turned into structural changes. That's to say, the intractability of the housing affordability crisis has come into focus, and millennials have responded accordingly. Even as some markets have seen construction ramp up and supply constraints ease slightly, prices have remained elevated near historic highs relative to incomes. For every bit of supply that comes online, demographic demand appears balanced in the other direction by growing millennial household formation, as this cohort ages into prime home-buying years. The assumption of housing affordability has been shattered. Over recent decades, as the economy grew and incomes rose, markets started to believe that homeownership would remain accessible to middle-class families. The crisis's ability to price out an entire generation overnight demonstrated the frailty of that belief. And so, the continued accessibility of homeownership is not as guaranteed as markets might have thought before 2020. The market will likely price this new reality long-term. So until housing supply substantially increases or demand moderates, the imbalance will likely have millennials paying more for housing than any previous generation, fundamentally reshaping their financial lives, delaying wealth building, and altering life choices from career decisions to family planning in ways that will echo for decades.